You've probably seen the headlines. The Indian rupee is hitting record lows against the US dollar. And when you hear that, it's easy to think it's all bad news, right? A clear warning sign. But the real story is, well, it's a lot more complicated. For a huge chunk of India's economy, this could actually be a great thing. So how can a falling currency be both a blessing and a curse? Let's get into it.
So this is the big question we're tackling today. A weaker rupee, is it good for India or is it bad? And the surprising answer is, it's both. It really is a two-sided coin. See, depending on whether you're selling stuff to other countries or you're an investor from overseas, this whole situation can either be your best friend or your worst enemy.
Okay, before we dive deep, let's just make sure we're all on the same page with the lingo. When you hear that the rupee is depreciating, all that means its value is dropping compared to other currencies, like the dollar. Put simply, today it takes more rupees to buy one single US dollar than it did yesterday. That's the core idea here.
All right, let's start with the good stuff, the upside. Now, it might sound a little backward, but a falling currency can be a massive win for a country's exporters. Think about it. For all those companies in India that sell their goods around the world, a weaker rupee is like getting an instant discount. It makes them way more competitive.
Let me show you exactly how this plays out. Let's say you have an Indian product that costs 8,000 rupees. When the exchange rate was 80 rupees to the dollar, an American buyer would pay exactly $100 for it. Simple enough. But now, with the rupee weaker at 85 to the dollar, that same exact product suddenly costs that American buyer only about 94 bucks. The Indian seller still gets their 8,000 rupees, but for the customer overseas, the price just dropped, thanks to nothing but the currency shift.
So this price advantage is a huge deal. It makes Indian products look way more attractive on the world stage. And it's especially helpful right now because it helps cushion the blow from things like high US tariffs. This doesn't just help a sector that's already doing pretty well, it actually pushes Indian companies to go out and find new markets to sell to.
Okay, but now we have to flip the coin. While the exporters are having a great time, there's another group that is absolutely feeling the pain. Foreign investors. For anyone who's put their capital, their hard-earned money, into the Indian market, a falling rupee can just eat away at their profits. Take a look at this number, 4.7%. That's how much the rupee has dropped against the dollar just this year alone. Now you might think, 4.7%, what's the big deal? But if you're an investment fund managing millions or even billions of dollars, a nearly 5% drop in the currency's value is a massive, massive hit to your returns.
And here's where it really hurts. Imagine an investor makes a decent profit in India, say 8,500 rupees. Back when the exchange rate was stronger, they could cash that out for about 106 US dollars. Pretty good. But today, at the weaker rate, that same 8,500 rupee profit is only worth $100. They've essentially lost $6, and their investment didn't even do anything wrong. The profit just vanished in the currency exchange. So what happens when investors see their hard-won profits just disappearing into thin air? Well, you can't blame them. They start pulling their money out. And this creates a really nasty cycle. The more investors sell and take their money elsewhere, the more downward pressure that puts on the rupee, which, you guessed it, can make the whole problem even worse.
Now, it's important to remember that the rupee slide isn't just happening in a bubble. It's being squeezed by a combination of powerful global forces and some challenges at home. So what's really behind all this pressure? There are really three big things happening here. First, the US dollar is super strong right now, and that's pulling money away from other markets, including India. Second, just like we talked about, foreign investors are selling off their Indian assets. And third, the Reserve Bank of India, the central bank, kind of has its hands tied. Its reserves of foreign currency are stretched, which means it doesn't have a lot of firepower to jump in and buy up rupees to prop up the price. It's a perfect storm, really.
Okay, so that's the situation. The big question is, where do we go from here? We're at a really critical point. Let's take a look at what could happen and the tough choices India's leaders are facing. There are a couple of things that could really turn this whole situation around. The first would be a big trade deal with the United States. You know, an agreement with India's biggest trading partner would be a huge vote of confidence. The problem is, there's a lot of uncertainty about if or when that'll actually happen. The other path to recovery is just pure economic power. If India's GDP growth really kicks into high gear, the promise of amazing returns might just be enough to lure those foreign investors back.
And this puts India's central bank in a super tough spot. See, to get the economy at home growing faster, they're thinking about cutting interest rates. That makes it cheaper for people and companies to borrow money and spend.
But here's the catch. Lower interest rates also mean lower returns for those foreign investors we keep talking about. So a rate cut could scare them off even more, pushing the rupee down further. It's a classic economic tightrope walk.
And that brings us right back to where we started, to that fundamental trade-off. What does India prioritize? Do you let the currency weaken to give your export industry a massive boost? Or do you try to keep it strong to attract the foreign investment you need for growth? There's no easy answer here, and the path that India's policymakers choose is going to define the country's economic story for a long time to come.